I didn't even read the PPM. I didn't realize there was zero cash flow for the first 2 years. If you only returned 80% of LP capital, but you took a disposition fee, I don't love that. You need a significant amount of capital to be able to live off that yield. You're not going to buy a course, invest a couple $100,000 into something and become financially free. It's way more.
Investors and operators, welcome to the Invest Clearly podcast. We have real conversations with passive investors and real estate sponsors. We go beyond the pitch deck to explore how trust is built, how capital is deployed, and what's driving decision-making on both sides of the private investment ecosystem. These aren't highlight reels. They're honest conversations about strategy, performance, and lessons learned. Whether you're an LP, GP, or somewhere in between, this is where transparency in the private market starts. Let's get into it. The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions. All right, Phil, thank you so much for joining us. And before we get started and before I hand it over to you to make introductions, is your background as cool in real life as it is on your LinkedIn? I saw a series of roles before you were now, from U.S. Marshal, Homeland Security, partner in a wine company, full-time LP. Like, seems pretty cool. Does that accurately represent your background?
It's not as cool. Yeah.
Yeah.
It's not. I promise. It's not like the movies. So
Yeah.
I assure you, it sounds cooler than it is.
Yeah. That's awesome. That's awesome. Well, why don't you tell us a little bit about yourself before we get started, and then we can hop right into it.
Yeah. So I was in federal law enforcement for 14 years. And at the time, I had a supervisor who recommended Rich Dad Poor Dad. He was a real estate investor, and we were on 2009. We were getting ready to be furloughed, and so he had said, I don't care if we get furloughed because I make more money from rental income, and that piqued my interest. So
Yeah.
I read the book, and then I started buying small multifamily properties and just kind of went from there. And then eventually, I quit law enforcement about 2.5 years ago. Went to real estate full time.
Nice, very nice. And that's all strictly on the what was, all right, let me back up. What was the journey like from the active investor to the LP investor?
So so I started with a 2-family, and then eventually I went up to an 8-unit, and then during that time period I invested in a syndication that was local to me in New Jersey. So that's a funny story because I actually didn't fully understand it before I invested in it, but
I've
eventually,
done that quite a bit lately.
yeah. So I didn't even read the PPM. I just had like a couple conversations, and the last conversation we had, he said to me, I'm excited to start putting some checks in your pocket. So I said, oh, okay, great. I didn't realize there was zero cash flow for the first 2 years because it was this value add multifamily property. I got in, that was totally lost on me. So,
Yeah.
in retrospect, that's so stupid, but that's the way it goes. It ended up being fine.
Yeah. It happens a lot of people, especially a couple of years back where it was mainly like, hey, sure, this sounds good. Real estate goes up, I'm in.
Right,
There's no way this could go wrong. But
yeah,
no, that's cool. So your portfolio now, what is the balance? Are you still doing the active stuff? Are you strictly investing in syndications?
so I'm strictly investing in syndications now. 100% of my income is from LP investments. So I have some in real estate, just different asset classes, mobile home parks, multifamily. Then I'm in some private credit, and then some private equity. That's just kind of how I have it chopped up now.
Yeah, good stuff. And how is it performing across asset classes?
So the multifamily, the 2 deals I'm in, that I invested in 2020. So that was supposed to be a 3-year hold, and like the exit cap rate was like a 5 cap in like the worst neighborhood. So we're gonna be okay because we're gonna achieve the same results just through a sale. So the sponsor did a great job. He's actually a really good guy, and the market completely turned on him, but luckily his underwriting was good enough to where we'll get out of this okay.
Yeah, that's great.
And then the private credit stuff, that's very steady for me. That's kind of like my baseline cash flow income. And then private equity stuff is it's all doing very well, thankfully.
Sure. And the private credit stuff, is that something that you've been investing in? I feel like it's becoming more and more mainstream now. Is that a newer pursuit, or what's your thought there?
For me, it's new. Yeah, absolutely. So I never really heard about it. I mean, I've read, debt funds, this and that, but like, um, I liked it because it obviously there's no upside to it, but the steady cash flow is what I needed just because I had left my job. So that's why it was
Yeah.
interesting to me.
Sure, makes a ton of sense. And so, what you're pursuing now, are you still making placements? Are you like what are you looking at moving forward?
Yeah. So moving forward, that's a good question. I'm trying to figure that out now, but I'm looking to diversify across more CRE sectors. So I currently don't have any exposure to industrial, so I'm interested in that. There's some sponsors I'm with now that I really like that I'm considering leaning a little bit more into. So I'm always looking, I'm always reviewing deals, and yeah, I'm always open to hearing, people's experiences.
Yeah, great stuff. So your progression from the first syndication, right? Didn't read the PPM, didn't realize value add was delayed cash flow to where you are now. Like walk us through that journey. How did you progress past that? Like lessons learned along the way. Have you taken a bad beat in between those things? Like tell us a little bit about that.
Yeah. So I ended up leaning really hard on people that I know were already invested in private placements. So I learned a lot just through that because I'm not the kind of guy that like digs through PPMs and reads it line by line and tries to under.
Yeah.
I mean I do read the PPM, but I really lean on people that are a lot smarter than me that I really trust. So I just hearing who they were investing with, what they look for, what they look at, like that was all very helpful for evaluating my own deals. So it was I didn't particularly like owning real estate. Like even I went from small multifamily to like single tenant net lease because I thought that was, it is more hands off. But it was still like I was still getting like I had a small shopping center and it was like a code official wrote me a violation because a 18 wheeler was parked there, or like we
Yeah.
got sued by the school board because they want our taxes to be higher. Like it was like, you know, and during that time I was still investing in private placements, and those deals were doing better than my active deals. So it for me it just didn't make sense to keep doing things directly when I could just place that capital with sponsors that were smarter than me.
Yeah, for sure. And how did you mentioned you lean on a lot of people you trust. One of the biggest things I hear from LPs is like the difficulty it is connecting with other LPs. I mean, there's
Right.
communities and masterminds and stuff now, but how did you find those individuals? Like, what did that were they already in your network, or like, what do you recommend people do to find that support system that you had?
So the the group that I am with now, there's everybody that works for them at Accountable Equity. They're also investors. So investors with Accountable Equity, but then they're also LPs in other deals. So we're always kind of talking about like where you have your money and
Yeah,
what's performing well for you, and because nobody thinks that you should have all your money with one sponsor. So that's huge for me because I just like bouncing ideas off them. And then just other people. Like as I start investing, as I start going to these meetups, you start meeting people and you hear about what they're doing. I'm not just saying this 'cause I'm on your podcast, but if I hear about a sponsor, I go to Invest Clearly to see if they have a profile, just because I like seeing what people have to say and the reviews and yeah, that's what's helpful.
that's great to hear. It's funny. Everyone always leads with like, "Oh, you're not paying me to say this," or "I'm not saying this because I'm on your podcast." That and then
Yeah.
says it. So that's great. No, that's awesome. And then in terms of like your deal flow and things like that. What does that look like from you? Because you mentioned you're looking at a lot of deals on a regular basis, and people a lot of the people I have on the podcast and to break down two things like evaluate the sponsor, but get the deal flow. Like make sure you're looking at a lot of deals. Where is that coming from for you?
So for me, I sign up for if I see ads or I'll just click on the website, I'll fill out the form and just get added to the distro
Yeah.
list and just start looking at them like that. And then I think I just I don't know if however I end up on these lists, I just start getting I don't want to say spam, but other deals just start finding me that way.
Yeah.
So that's how I review deals really.
Sure. And do you have like like immediate red flag markers or like green flag markers that say, "Hey, I looked at this as an immediate no. I looked at this as an immediate yes." Like, how are you evaluating them quickly to know like is this worth my time or not?
So since I live off this income, I'm hyper focused on cash flow right now. I mean, I
Yeah,
want equity growth, but really like in place cash flow is important to me. So that's number one. I'm not really interested in like, ground up development or something like that right now. So, and as far as red flags, I'm not investing in first time sponsors generally. I'm looking at multiple market cycles. You know, ideally back to the early 2000s or even like the 90s. And I also like to hear that deals went bad for them.
yeah,
I'd like to hear that things didn't work out. I just want to know what they learned from that or how it worked out or how they pivoted. But also like for deals that don't work out, for example, if you only returned 80% of LP capital, but you took a disposition fee, like I don't love that, or
yeah.
things like that. You know what I mean? So that's just kind of what I'm always looking at.
Yeah, sure. Well, I'd like to dive a little more into your sort of the fact that you are living off this full time. I feel like that's a lot of the people that I bring on the show. They're not professional LPs. Most of the people are doing this on the side or building up towards that. Like, I want this to replace my income. Um, what was that like for you in terms of, I guess, like aggressively investing? Like, how did you make the decision early that it was cash flow over equity? Because there's a big like appreciation equity play in this that it could be huge. So making that delineation, I guess, for someone who's trying to make the transition is critical. Like when you're thinking about maybe mindset as an investor that's working a W-2 that wants to invest in this until it covers their income, what advice do you have for them?
I mean, when I first started out, I thought I was gonna be buying duplexes in bad neighborhoods for
Yeah,
the rest of my life. Like I
yeah,
thought that was like the holy grail of investing. So been a lot of like mini pivots along the way, but I always knew that ultimately I wanted to quit my job. So I mean, look, it's hard for me to give advice to people because there's so many variables.
yeah,
I mean, it took me 10 years of banging my head against the wall, buying these small properties, collecting the rents, dealing with all the issues, you know, obsessively focused on harvesting the equity, reinvesting cash flow, and just slowly getting toward that goal of, financial freedom. So
yeah,
eventually for me, that was diversifying across private placements. That's ultimately what I came to when I realized I didn't want to be owning properties myself. So I guess I would say you really just need to figure out your risk tolerance. Do you want to do this yourself? Do you want to be in an LP equity or a mixture of both? But for me, I couldn't find stable cash flow by owning multifamily. It was great, then it wasn't great, then it went. So I couldn't, like to leave a job and depend on that to me was, I couldn't do it. So I needed to put together enough capital to where really private credit was very helpful because it was steady, then equity investments with cash flow, and then more equity growth focused investments. So that's kind of so as those come full cycle, I get more cash back. I can redeploy in things that are cash flow focused. So that's kind of what I'm always doing every 6 months.
yeah. And how did you come up with that framework? Like was it a you were like okay, I'm going to do this for this amount of time, this asset, private credit for this amount of time. It's going to exit at this point so I could reinvest it here. Was that a work in progress, or are you pretty like put the paper down, this is the plan, let me roll with it, or was it like learn and adapt kind of thing?
Learn and adapt. It was
Yeah.
like totally learn and adapt. Yeah, absolutely. It was just seeing what worked and thinking, oh, I'm gonna lean into this a little bit more, and then kind of get some exposure to this. But it definitely wasn't like, hey, this is the roadmap. Like I said, I thought I was gonna be buying two families the rest of my life. So it was like,
Yeah.
you start to kind of learn as I talk to people and learn different ways of looking at things. You don't really know where you're gonna end up. You just kind of have to keep progressing.
Pivoting.
You know
Yeah.
exactly, and then you figure out where you want to be.
Yeah, very cool. This episode of the Invest Clearly podcast is brought to you by Scale IR. If you're raising capital, you know the hardest part isn't just generating leads, it's turning those leads into committed investors. That's where Scale IR comes in. Scale IR transforms your investor engagement process with their proven solutions that optimize lead qualification, accelerate investor conversations, and drive higher conversions. From seamless CRM integration and intelligent workflows to expert investor qualification specialists who handle your initial discovery calls, Scale IR gives your team freedom to focus on closing deals. If you're ready to scale your investor relations and capital raising effectiveness, visit scaleir.com to learn more and book your strategy call today. Scale IR. Engage smarter, convert faster. I'd love to learn, we talked about it a little bit. You mentioned that you've got this network of people around you that help you figure out which sponsors you're going to work with. You talked a little bit about like how they bring up track record, not new sponsors. Obviously, Invest Clearly is all built around like trust with GPs. What is, I guess, how do you find trust in deals that you're underwriting, right? And not just like the red flag, green flags, like what are your like true trust signals? And then how does that also translate to like, this is why I would trust a GP? Can you walk us through that evaluation a little more?
Yeah. So, um, I think the way sponsors responded in really hard times is very telling for how they view LPs and LP money. So, I guess this all goes back to like, it's all about the sponsor, but my example of taking a disposition fee and not returning 100% LP capital is just one example of a sponsor that, in my opinion, is not really looking out for LPs. So I really like to hear from sponsors about past deals that didn't go perfectly and how they handled that, and what the net return was for LPs. That's really, really big for me.
Yeah, sure. And it seems like that wasn't as much as of a focal point up until recently because not many people had things going wrong until,
Right.
fortunately, until lately. How do you, when you think about that, how do you differentiate between like what I like to call is like contextualized track record? Like, was it market? Was it operator? Does that matter to you? Because people bring that up a lot. It was like, hey, this is just a poor operation. Hey, there was literally nothing they could do. A good operator sometimes has bad deals. How do you
Sure.
differentiate between those two?
So, like looking at track record, like if all of their full cycle deals were during that multifamily run up, like obviously that is a bit of an anomaly, right? Because everybody did well in multifamily during those times, right? Like I'm one of them. I bought it. Everything that I bought was in 2015 up until 2021 just went up, right? So like I didn't have
Yeah.
any brilliant value add plan or anything. I just bought it, waited, and I got lucky enough where it just went up in value. So if a sponsor's whole track record is that's not very valuable to me, which is why I like to see multiple market cycles and just how those deals performed and what went wrong and how they handled it.
Yeah, for sure. And you mentioned, you were in these multifamily deals. You've got a wide variety of asset classes. Do you underwrite asset classes differently? For example, you're going to start looking at industrial, right? Is the way you make decision about industrial, which is completely different than multifamily, like, do you underwrite them differently? Because it's more commercial based and like commercial based residential, the demand for it, macro, impact and things like that.
Yeah, definitely. So you know, from what I understand, this idea of onshoring and certain manufacturing sectors having more demand now seems to be a tailwind for industrial. So
Interesting.
that's what's interesting to me. And then for example, like the multifamily space or mobile home parks, the demand for affordable housing is still a problem, and that seems like it's a growing sector from everything. So that's just the way I look at it. So yes, I'd say it's very different the way I analyze certain things. Just that's seems to be where the data is.
For sure, for sure. Awesome. And you mentioned accountable equity a little bit earlier. You recently got involved with accountable equity. What is your role with them, and what had you decide to, I guess, start working with them?
Yeah. So I had listened to the CEO, Josh McCallum's podcast. I had listened to it when I was in law enforcement years ago. I just listened to his podcast. So eventually, when I started looking at private placements, accountable equity had come up. So I started investing with them. Then they put on these investor events called Learn and Grows at each resort. It's mostly in the hospitality sector. So I went, I met Josh, I met the whole team, and I really fell in love with their whole culture, and the way they do everything. So I just asked to get involved, and so I just started helping them free, and eventually I'm now part of their team. But I think the way they do things, the way they handle things was very rare in this space.
Yeah, it's pretty cool. And I've met a couple members of the team in person at an event. You and I have spoken a couple times. And is Kellen? Is that his name? Who am I?
Josh,
I,
Josh McCowan.
no, it was somebody else. I can't remember off the top of my head. But I distinctly remember going up to him and same thing. He was an external individual that was just a large investor in the company, and then also like operated in support of the company as they were growing. And it seems like a
Right.
pretty unique niche that you guys have carved out.
Yeah. Yeah.
It-
It's definitely interesting. The debt fund I'm in is with them. So I usually have a rule about how much I allocate toward one sponsor, and I broke that rule with them just because I like them so much.
Yeah, what is that rule? I'd love to hear about that.
Well, I mean, I wouldn't say it's a set percentage, but I'm just aware of how much is allocated toward one sponsor. So if one sponsorship gets into trouble, I don't want the whole ship to go down with them, right? So,
Yeah,
but that's kind of
something to pay attention
generally,
to, pretty
yeah, it's
much.
just yeah.
Yeah. So when you're making these investments, are you constantly, and this just kind of made me think about this question, but are you looking for new sponsors constantly, or are you looking to reinvest with the sponsors that you have, just not too much into one spot?
I'm not looking. Well, new sponsors meaning new GPs
Yeah, new
or new
GP,
to
sorry,
me.
like new
Yeah,
new companies to invest with.
I'm not super interested in new GPs. Like I said, I because if you have a W-2 income and you're investing in private placements on the side, that might make more sense to find an emerging GP that you
I
can
for,
do really well with. You know what I mean? For me, that's not the case. Like, I get like there's brokers that reach out to me all the time that are like, I've been a broker for 5 years. I have this great idea to buy a value add multifamily in Texas. I'm like, I'm not interested in that. Like
yeah,
I like track records. I like, ideally like, audited financials or just a whole bunch of people I can talk to that have invested with them, reviews.
yeah.
That's what I like to see just because it's my livelihood.
For sure. And I phrased that super poorly. What I meant was, are you looking for additional GPs outside of the ones you guys are working with, the ones you currently have experience in?
Absolutely. I'm always
Yeah.
looking for strong GPs with great track records, in asset classes that I'm interested in. And I can be, talked into that, honestly. Something that maybe I wasn't considering before. After looking at GPs and seeing what they're doing, I'd consider it.
Sure.
Absolutely.
Awesome. 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 All right, Phil, I want to ask you the one question I ask in every podcast. It's my favorite question to ask. What part of passive investing do you think needs to die?
So I would say there's a lot of influencers in this space that say, buy my course, come to my seminar, become financially free through LP investing. I think the point that gets missed is you need a significant amount of capital to deploy to be able to live off that yield responsibly. So, however you can come into that money, whether you sell a business, you hit the lottery, some large inheritance, or you take 10 years of buying, a little bit of properties and, banging your head against the wall. It's not that easy. I
Yeah.
guess that's my point. You're not going to buy a course, invest a couple $100,000 into something and become financially free. It's way more complicated and difficult than that. I mean, if I can do it, anybody can do it, but it's not easy.
Yeah, well, it's not even just the strategic side of things. Like you have to be able to measure risk. You have to make the right decisions. You have to choose the asset class and the type
Right.
of returns. And it's really really interesting. Some of the people, and it's heartbreaking too. Some of the people that the unfortunate position that I'm in is, yes, I'm putting this platform out there to help people, but if you got to help people, it means someone got hurt. And I've talked to a lot of people that have bought into that, right? And
Right.
it's not I don't want to say like marketing's not bad, but there's a threshold where like you like relinquish ownership and accountability because you believe someone and then you get beat up, and it's like,
Right.
goodness, like just take a step back and really think about this and pay attention to it and like learn the actual steps, because it is possible to quote unquote be financially free. Like, look at yourself, you went through that journey, but it wasn't like, oh, I did this in 6 months, a year. There's a
Right.
path to it, and
Yeah.
it's difficult mentally, I imagine too.
Yeah. I mean, there were times where there was weeks, like every week I'd say, this doesn't make any sense. Like, this doesn't work. Like, what am I doing? Like, even when I left my job, it was like, I wasn't easy. I got
Yeah.
3 kids and, it was, but yeah, nothing's easy.
Yeah, no, no, definitely not. And the last question I have for you, on your LinkedIn, you are a partner in a wine company as well. Is that accurate? Are you operationally there? Are you investor in there?
Yes. So I'm partners. We're partners. The wine is actually produced by one of Accountable Equity's properties at Bohemian Manor Farm. So that was the relationship I had. Now, the person I'm partnered with is somebody named Anthony Arulata, who's relatively well known in his genre. So we had crossed paths both in our previous lives, me in law enforcement, him in what he was doing. So we had the idea to form a wine, and
That's awesome.
here we are.
Yeah, very artful way to describe that. By the way, I went to Springfield College, so in
Okay.
Massachusetts. So I saw your LinkedIn. I'm familiar. Very cool,
Yeah. I'm
Phil.
from.
Well, thank you so much for joining me. It's been really great getting to know you, on both the LP side and then through Accountable Equity. So it's really cool. If people want to get in touch with you, what's the best way to do it? Yeah,
Yeah, you could reach out to me on LinkedIn, or you could email me. It's pboggia@accountableequity.com.
great stuff, Phil. Thank you so much.
Yeah, thank you.
That's okay. Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review, because that's how other people find the show. Till next time, invest clearly.